Shares of Cenovus got a boost today after the Alberta-based company logged a beat on profit and revenue. So here to tell us more is Menno Hulshof, Managing Director at Equity Research at TD Cowen. It's good to have you join us. Thanks for your time.
Thanks for having me on.
So let's go through these kind of better than expected results. What's behind this?
Yeah, it was a good quarter from Cenovus across the board, both upstream and downstream. On the upstream side of things, they posted record top line production. That was expected given the Meg acquisition. But I think the important piece here is that we saw production records set across all major upstream assets, including Foster Creek, Christina Lake, and Sunrise. And similarly, U.S. downstream, as you may appreciate, that's been a headwind for the stock, but the performance there was quite strong as well from a market capture and utilization perspective, despite weak crack spreads. So I would say that Cenovus delivered on everything that it could control in the quarter. And I think that makes for a solid downstream setup through the middle of the year, given limited turnaround activity and seasonal strength. And then when you think about the results on the cash flow per share side of things, not surprisingly, strong asset level performance drove a roughly 6% beat relative to our estimates after a couple of larger adjustments. But beyond the quarter, I think it's all about delivering on best-in-class production and free cash flow per share growth in 2026 and beyond as production ramps and growth capital starts to fall. And the good news from the quarter and from the conference call, for that matter, was that all of their growth projects are tracking per guidance or slightly ahead of guidance, including Narrows Lake and the Foster Creek optimization project. Now, the one project that we are keeping an eye on is West White Rose, which is offshore East Coast. And Cenovus continues to guide Q2 for first oil, but did suggest on the conference call that timeline might be a bit tight. So we are keeping an eye on that one. But even with a slight delay, we would argue that the window for material delays or overrun has effectively closed. So we like Cenovus here. I think it remains one of the most interesting names within our coverage from a rate of change perspective, along with Suncor. And when you think about shareholder capital returns, they continue to return 50% of free cash flow, and that's expected to increase to 75% when net debt falls to $6 billion. So we continue to like it here, notwithstanding the recent strength.
It's interesting how you say that Cenovus is doing well within all the areas that it can control, right? Because there's so many factors out of an oil and gas company in Canada's control right now, including, we're seeing lower crude prices, generally lower crude prices recently. How is Cenovus managing the lower cost per barrel?
Yeah, I think it's a combination of a lot of different things. They've made a big push to lower their break-even costs coming out of the 2020 COVID downturn, and now they have a break even down to $45 WTI, which is a very comfortable place relative to where we sit today. And the other piece that is worth highlighting, of course, is the integration of the business. They have a very significant U.S. downstream footprint, which helps mitigate volatility in oil prices. And the Canadian downstream side of the business continues to perform very well as well.
Obviously, a big story as well. I think you might have touched on this briefly, but Cenovus acquiring Meg Energy. How is that factoring into some of the results in Cenovus's production moving forward?
Yeah, it's early days, but the integration is going very well. They talked about that extensively on the conference call. There haven't been any hiccups in terms of the integration to date. And when you think about the synergies upside from that deal, they were guiding $150 million in synergies over the near term, increasing to about $400 million in synergies by 2028. And I think the interesting piece there is that they managed to generate $120 million of the $150 million near-term target within 6 weeks of closing of the transaction. So it continues to integrate extremely well. And I think there's probably, we don't know definitively, but if I had to guess, if we were having this conversation a year from now, that synergies estimate is potentially even a bit higher.
Given the demand for data centers that we're seeing and probably will continue to see into the future, is Cenovus expecting higher natural gas prices?
Yeah, I wouldn't. Like Cenovus, they do have a fairly significant footprint in a play called the Deep Basin, and that's where they generate most of their natural gas. But their natural gas sensitivity is very low, simply because they consume a lot of it within their core SAGD business, but they do, yeah, they do have a bit of a gas weighting, but it's not going to be, in my mind, a tailwind for the stock, even if we do see a significant uptick in natural gas demand on the back of the proliferation of AI data centers.
A big conversation in January was whether Venezuelan oil would be threatening Canadian crude oil and Canadian oil and gas companies. That's kind of died down. Not as many people talking about that this month, but we know Mark Carney has said that he's not worried about that. Would you agree with that? And do you think that's something Cenovus is looking at in the future?
I would say that most of the companies in my coverage are. I mean, it's too early to say. The visibility is extremely low. We don't really know how things are going to play out, but we have seen the heavy differential come under pressure of late. As of yesterday's close, it was just under $16, and that's a bigger number than we would have expected even 3 months ago. Like, to be fair, it is a seasonally weak time of year, but even if we look at things on a year-on-year basis, the heavy differential is about $2 a barrel wider than this time last year. In terms of why, and I'll get to the Venezuela piece, but I think the biggest reason is probably Western Canadian supply, which hit record highs in December and does appear to be impacting Enbridge mainline apportionment, which rose to about 22% for heavy oil in February. But when you think about Venezuelan imports into the U.S. Gulf Coast and the potential to have those backing out Western Canadian heavies, we haven't actually seen that yet. We've seen imports rise into the 150, 155,000 barrel per day range, but that's only up marginally from early January when the U.S. triggered regime change. But it is something that the industry is taking very seriously, and it can go a lot of different ways. Okay, we're going to have to leave it there. We're out of time. Menno Hulshof, appreciate you joining us today. Thank you. Thank you. And Menno is the Managing Director of Equity Research at TD Cowen.